Welcome to the Warren Method, the channel that doesn't sugarcoat wealth-building truths. Today, we're dropping a financial bombshell that could save your retirement from the IRS's claws. Warren Buffett. 7 retirement tax traps you must avoid in Los Angeles. Picture this. You're 66, finally retired in sunny Los Angeles, ready for Hollywood walks and Venice Beach sunsets. You open your tax bill. It's not $5,000. It's not $10,000. It's $42,000 because you triggered a hidden tax trap that turned your golden years into a nightmare. Now, instead of dining in Santa Monica, you're selling your car to pay Uncle Sam. This isn't a movie plot. It's happening right now in LA, where 55% of retirees face unexpected tax bills averaging $38,000 a year, according to a 2025 Fidelity report. But the rich, the ones who live by Buffett's unbreakable rules, never pay a dime more than they must. They dodge 7 tax traps that devour retirement savings in high-cost cities like Los Angeles, where state income tax hits 13.3% and property taxes keep climbing. If you're an investor, an entrepreneur, or someone who refuses to let the IRS steal your future, lock in for the next 55 minutes. We'll expose the 7 tax traps crushing LA retirees, how Buffett avoids them with surgical precision, real stories of Angelenos who lost hundreds of thousands, strategies to slash your tax bill legally, and a Q&A that puts money back in your pocket today. If this alarms you, type LA tax in the comments right now. Subscribe, hit the bell, and don't blink because trap number 7 will make your jaw drop. Let's dive in. Let's set the scene. Los Angeles is a retirement dream turned tax hell. The average cost of living here is $5,100 a month, 60% above the national average. In 2025, California's state income tax tops out at 13.3%, and LA County adds property taxes that rose 8% last year alone. Yet, 55% of LA retirees get hit with surprise tax bills because they ignore Buffett's golden rule. Taxes are your biggest expense, minimize them ruthlessly. Warren Buffett, with his $900 billion empire in 2025, pays less than 1% effective tax rate on his wealth. He holds Coca-Cola since 1988, zero capital gains tax. His Berkshire Hathaway avoids dividends, keeps cash flowing tax-free. In 2008, he turned $5 billion into $15 billion with Goldman Sachs, all tax efficient. The rich in LA follow this playbook. They never trigger taxable events, never miss deductions, and never let emotions override tax strategy. These 7 tax traps don't just delay retirement, they obliterate it. One trap can cost you $200,000 over a decade. Another turns your Roth dreams into a taxable disaster. Buffett's discipline is your weapon. Will you wield it? Comment below which tax trap scares you most. Let's dismantle them. Trap number 1. Cashing out retirement accounts early. The rich never touch their 401k or IRA before 59 and a half. In LA, where cash is tight, retirees often withdraw early for emergencies. Big mistake. You pay 10% penalty plus ordinary income tax, up to 37% federal plus 13.3% California. Meet James, 62, from Pasadena. In 2023, he withdrew $150,000 from his 401k to cover medical bills. Paid $45,000 in penalties and taxes. His nest egg shrank and he triggered higher Medicare premiums. Now works Uber at 65. How do you avoid early withdrawals? First, build a 6-month emergency fund outside retirement accounts. Second, use Roth conversions in low-income years. Third, tap home equity lines before IRAs. Fourth, explore hardship withdrawals only as last resort. Fifth, live by Buffett's rule. Your retirement accounts are sacred, touch them and you pay forever. Ask yourself, have you ever withdrawn early? Comment yes or never. Hashtag retirement taxes trap number 2. Ignoring Roth conversions. The rich never leave all their money in traditional IRAs. In LA with high state taxes, traditional IRA withdrawals get hammered. Roth conversions let you pay tax now at a lower rate, then grow tax-free forever. Meet Susan, 68, from Santa Monica. She had $800,000 in a traditional IRA. Started withdrawals at 72. Paid 30% federal, 13.3% California, 43.3% total. Lost $340,000 to taxes over 10 years. How do you master Roth conversions? First, convert in low-income years before RMDs. Second, spread conversions over 5 years to stay in lower brackets. Third, pay conversion taxes with non-retirement cash. Fourth, use a Roth ladder strategy. Fifth, follow Buffett. Pay taxes once, minimally, then never again. Comment. Do you have a Roth IRA? Yes or no? Hashtag investing trap number 3. Missing required minimum distributions. The rich never forget RMDs, but they minimize them. In LA, RMDs start at 73 in 2025. Miss one and you pay 50% penalty on the amount you should have withdrawn. Meet Robert, 74, from Hollywood. Forgot his first RMD $50,000. IRS hit him with $25,000 penalty. His Social Security got taxed higher too. How do you avoid RMD disasters? First, set calendar reminders 12 months before 73. Second, use QCDs, qualified charitable distributions, to satisfy RMDs tax-free. Third, convert to Roth before RMD age. Fourth, work with a CPA annually. Fifth, channel Buffett. Plan taxes a decade ahead, not the year of. Comment. Are you tracking RMDs? Yes or no? Hashtag retirement planning trap number 4. Holding dividends in taxable accounts. The rich never let dividends get taxed yearly. In LA, qualified dividends face 15 to 20% federal plus 13.3% California. Meet Linda, 69, from Westwood. Her taxable account paid $30,000 in dividends yearly. Lost $9,000 to taxes annually. Moved to tax-deferred accounts, saved $90,000 over 10 years. How do you shield dividends? First, hold dividend stocks in IRAs or 401(k)s. Second, choose growth stocks over high yield in taxable accounts. Third, use municipal bonds for tax-free income. Fourth, reinvest dividends automatically. Fifth, Live by Buffett. Coca-Cola dividends in Berkshire, zero personal tax. Comment. Where do you hold your dividends? Taxable or tax-deferred? Hashtag Warren Buffett trap number 5. Forgetting tax loss harvesting. The rich never miss a chance to offset gains. In LA, where portfolios swing with tech stocks, losses are inevitable. Harvest them to deduct up to $3,000 against ordinary income yearly. Meet David, 67, from Culver City. Sold Tesla at a loss in 2022, didn't harvest. Paid $20,000 extra in taxes. Now harvests annually, saves $8,000 a year. How do you harvest losses? First, review your portfolio every December. Second, sell losers to offset winners. Third, watch wash sale rules, 30-day repurchases. Fourth, carry forward and used losses indefinitely. Fifth, follow Buffett. Turn market pain into tax gain. Comment. Do you tax loss harvest? Yes or no? Hashtag retirement wealth trap number 6. Triggering Social Security tax torpedoes. The rich never let benefits get taxed up to 85%. In LA, with high provisional income, combined income over $44,000 for singles triggers taxes. Meet Patricia, 71, from Echo Park. Started Social Security at 62, Worked part-time. 85% of her benefits taxed. Lost $12,000 a year. How do you avoid the torpedo? First, delay Social Security to 70 for max benefits. Second, keep provisional income low with Roth withdrawals. Third, use QCDs for RMDs. Fourth, time capital gains strategically. Fifth, live by Buffett. Plan income streams to minimize tax drag. Comment. When will you claim Social Security? Age or already? Hashtag investing trap number 7. Overlooking California Prop 13 reassessments. The rich never let property taxes explode. In LA, inheriting a home resets property tax basis under Prop 13. Meet George, 65, from Beverly Hills. Inherited his parents' home, assessed at $3 million. Property tax jumped from $5,000 to $35,000 a year. Sold the house to pay taxes. How do you avoid reassessments? First, use parent-child exclusion forms before transfer. Second, consider trusts to maintain low basis. Third, downsize before inheritance. Fourth, appeal assessments annually. Fifth, follow Buffett. Know every rule in your jurisdiction, taxes compound. Comment. Do you own property in California? Yes or no? Hashtag retirement traps. Now the full case study. Meet Karen, 63, in 2020, from Silver Lake. $600,000 retirement portfolio. She fell into all 7 traps. Withdrew $100,000 early from 401k, paid $30,000 in penalties. Ignored Roth conversions, lost $250,000 to taxes over 10 years. Missed first RMD, paid $20,000 penalty. Held Apple dividends in taxable account, lost $8,000 yearly. Never harvested Tesla losses, paid $15,000 extra. Claimed Social Security early, 85% taxed. Inherited home, property tax tripled. Total lost, $550,000 plus stress. In 2023 she found the Warren method. Converted to Roth, set RMD alerts, moved dividends to IRA, harvested losses, delayed Social Security, filed Prop 13 exclusion. By 2025, her portfolio hit $850,000. On track for $2.5 million by 70. She's back hiking Runyon Canyon tax-free. Comment. Which of Karen's traps hit closest to home? Hashtag tax strategy. Buffett versus tax gurus. Dave Ramsey says pay off debt, ignore taxes. Buffett says minimize taxes legally, always. Susie Orman says max 401k but ignore state tax. Buffett plans for California's bite. Robert Kiyosaki says real estate deductions. Buffett says hold forever, defer taxes. Winner? Buffett. His effective tax rate under 1%. Comment. Buffett or Ramsey on taxes? Hashtag Warren Buffett 2026 retirement tax trends in LA. 5 shifts coming. RMD age rising to 75. Roth 401k, mandatory for high earners. AI tax software catching deductions. California muni bonds surging. Federal tax brackets adjusting for inflation. Buffett's response. Avoid all 7 traps. Convert early, harvest losses, delay benefits, hold forever. One LA viewer saved $60,000 in taxes last year. Extended Q&A. 10 burning questions. Question 1. Best year for Roth conversion? Answer. Low-income years before 73. Question 2. How to avoid RMD penalties? Answer. Set auto withdrawals with Vanguard. Question 3. Municipal bonds worth it in LA? Answer. Yes, tax-free federally and state. Question 4. Can I undo an early withdrawal? Answer. No, but offset with losses. Question 5. Best tax software? Answer. TurboTax Premier or a CPA. Question 6. Should I move out of California? Answer: only if taxes exceed lifestyle value. Question 7. How to teach kids tax strategy. Answer: start Roth IRAs at 16. Question 8. Buffett's top tax rule. Answer: defer, defer, defer. Question 9. Prop 13 exclusion deadline. Answer: file within 3 years of transfer. Question 10. Where to learn more. Answer: Buffett's letters, irs.gov, the Warren method. Final warning. You now know the 7 tax traps. The rich never trigger them. Will you? Take one action today. Schedule a Roth conversion. Set RMD alerts. Harvest losses this December. File Prop 13 forms. Smash like if this saved you thousands. Comment your biggest tax fear. Share with one LA retiree. Poll: will you act on trap number 1 this year? Subscribe to the Warren Method. Next, Warren Buffett. 5 retirement income machines in Los Angeles. See you in the comments. Your wallet is watching. #retirement taxes.